had talked about last week was in regards to FDIC insurance. And just to be clear, there is still an FDIC minimum of $250,000. However, the question I was answering was about bank runs. And in the situation of a bank run, everybody runs into the bank and they want to withdraw their money here and now. And the danger that we're in at this point is that no longer a mandatory minimum reserve per the Treasury and the Federal Reserve. So what that means for FDIC insurance is that you may have a $250,000 minimum insured amount in that account, or up to $250,000. If there's a bank run, that doesn't mean the bank has $250,000 to simply hand to you. So that basically means that, there is a required insurance out there. As I said last time, it's not insured in the same way that people think that it is insured. It's only insured in that at some point down the line, the Federal Deposit Insurance Corporation will do what it can to back up that money, but it doesn't mean you can go get it out of the bank, hold it in your hands, and be responsible for it, which, as you were talking about, personal responsibility for finance, and that's why DeFi is so important. DeFi is really just a decentralized finance mechanism. You actually own your personal finances. So instead of putting your money into a house and hoping that the house is taken care of, or putting in a 401k and hoping that retirements all go well, you're putting your money into something which you actually control. And in the case of Reaper, we actually pay you to hold your own money. So it's a great mechanism that really changes the way people can take control of their own finances.
Patrick, I want to get into the decentralized finance pieces, because I think when you look at what happened in Canada and you talk about the ability now to really be, and correct me on my lingo here, but you really get to be your own custodian, right? You can be your own custodian of your own money, is very, very powerful. So I want you to explain that. But first, let's back up to the FDIC piece, because I want people to really be clear on what you're saying here. So what you're suggesting is there used to be this $250,000, or there still is $250,000 insurance at the FDIC. Just the Biden administration changed it so there doesn't have to be the amount of reserves in the bank. So hypothetically, if I had 100 grand in my bank account and bank run started and I went to the bank and I wanted to take out my 100 grand, it's insured, but I'm not guaranteed to actually get that 100 grand back. Is that what you're saying? Or give it to me like I'm a
That's
5-year-old?
correct. That is correct. And I do just want to also that this was 26 March of 2020 as well, that they dropped the mandatory minimum reserves. So not only the Biden administration renewed this in February of 2022, but this was done back in March of 2020 as well.
So help me understand, like, if there's still the insurance, but so what was put out on 3/26/2020? They said, hey, now you don't have to have any money in there to cover this, or help me understand what was exactly communicated. And I'm assuming it was an EO or something that was put out.
Yep. So I'll read this direct from the Federal Reserve. So effective for the reserve maintenance period beginning March 26, 2020, the 10% required reserve ratio, which is they had to have $10 for $100 that was in the account in the bank. Net transaction deposits above the low reserve tranche level was reduced to 0%. The 3% required reserve ratio against net transaction deposits in the low reserve tranche was reduced to 0%. So that reduced the mandatory required reserves across the country by about 200 billion at the time.
So that's a lot of bank talk to me. Talk to me again like I'm a fifth grader.
Okay. So to kind of break that down, basically what it means is that even though your money may be insured, if it was in a worst case scenario or a Wall Street crash like 1929 and everyone ran to the bank to get their money, that money is not necessarily there in the bank unless the bank has done something independent of the Federal Reserve or independent of Treasury guidance to make sure that they have funds on hand. So basically, the bank would probably close the doors, lock it, and you're going to hope at some that the banking system that is digital is going to get up and running, and you're going to have some value left. But that value of $250, if you look at Venezuela, Argentina, Greece, Turkey, if there was an actual bank run, that $250,000 you're after today may be worth $50,000 by the time you actually get it.
But it's insured up to 250. So if I've got insurance, why wouldn't I get the full 250 if it's insured?
Well, you would get the full 250, but it may not buy you what 250 buys you today. It may buy you what a 20,000 car is worth today by the time you get it.
I shouldn't laugh because I mean it's very serious, but it's very true. I mean, you look at the Weimar Republic. I got to say this, and I've said this before, and I want to get your take. And when we come back, knowing this, I want you to talk about, okay, so now that I hear this about the FDIC, what can we do? How can we educate people and empower people around finance? But I just want to share with you, the CEO of FedEx said, basically, thank God for Joe Manchin, because imagine if we would have flooded the zone with another $5 trillion with the Build Back Better. He said, we would have been the Weimar Republic. I've got 60 seconds, just your response.
Yeah, so I think just the flooding of money in general over the last 2 years, about 60% of all US dollars in circulation is put in within the last 2 years. And obviously, the American citizen is feeling that hard on inflation right now. And as Jerome Powell talked about today with fighting inflation, there is a good chance of a recession coming. And that's probably necessary. We either have runaway inflation or we have a recession. We can't have both, or excuse me, we can't have one or the best
Right.
of both worlds.
Patrick, if you don't mind, 'cause we're going to keep Patrick around for the next